Just days before taking his $47 billion company public, Adam Neumann forced WeWork to pay him $5.9 million for the right to use the word we. It was the biggest red flag in modern financial history. You assume it was just another tech startup that grew too fast. You look at the collapse of WeWork and realize the entire foundation was built on an illusion designed to siphon billions from investors while operating a fundamentally broken business model. You think it was a tragic miscalculation. How exactly does a company evaporate $37 billion in valuation in just 6 weeks? The answer lies in corporate delusion. You are about to discover how a real estate subleasing business disguised itself as technology. You will see how SoftBank and its founder, Masayoshi Son, poured billions into this broken model by demanding growth at any cost. You watch the facade crumble. Why did no one look at the fundamental unit economics before writing a check? But the real secret to WeWork was never about building a vibrant community for entrepreneurs. It was a highly dangerous game of financial arbitrage. It started in 2010. Adam Neumann and Miguel McKelvey founded WeWork in New York City. They had previously run an eco-friendly co-working space called Green Desk before selling it. They used the cash to launch a brand new concept that promised to revolutionize the way millennials and freelancers interacted with their physical environment. They pitched space as a service. Does giving people free beer and fruit water really justify a massive tech valuation? The underlying business model was remarkably simple and completely unoriginal. They signed massive commercial leases with landlords for 10 to 15 years at a steep discount. They chopped the space into smaller glass-walled offices. They subleased those tiny spaces to freelancers on flexible month-to-month contracts at a massive premium, capturing the spread as revenue. The timing was absolutely perfect. Coming out of the 2008 financial crisis, commercial real estate was cheap, and landlords were desperate to fill vast, empty towers. How long can a company survive when it locks in rigid long-term liabilities but relies entirely on flighty short-term revenue? This duration mismatch is the silent killer of arbitrage businesses. You secure a lease for 15 years. You owe that money regardless of whether the economy is booming or crashing. You rely on tenants who can cancel their memberships with just 30 days of notice, meaning any slight economic downturn would instantly wipe out your income while your expenses remained perfectly fixed. The valuation climb defies all rational financial gravity. In 2014, the company was valued at roughly $1.5 billion. 2 years later, that number skyrocketed to $10 billion. SoftBank and the Vision Fund stepped in during 2017 with a massive injection of $4.4 billion. This pushed the valuation to an unprecedented $20 billion. How does a company that simply subleases office space become more valuable than the landlords who actually own the buildings? Masayoshi Son famously drove Adam Neumann to grow faster at all costs. He told Neumann to make WeWork 10 times bigger. He explicitly told his protege that he was not being crazy enough, effectively giving him a blank check to abandon any pretense of profitability in exchange for sheer global scale. The market watched in awe. Why do venture capitalists consistently reward reckless expansion over sustainable unit economics? Adam Neumann successfully hypnotized the private markets. He pitched WeWork as a technology company and a physical social network rather than a traditional real estate firm. This allowed the company to command software-level revenue multiples instead of the grounded single-digit multiples assigned to boring commercial real estate companies. Critics warned it was a dangerous charade. You see a company dressing up a capital-intensive business with ping-pong tables and neon signs. Do ping-pong tables magically change the fundamental cost of pouring concrete and hanging drywall? The internal culture under Neumann was chaotic and notoriously cult-like. You watch the CEO serve tequila shots to employees immediately after announcing a wave of brutal layoffs. The company culture demanded absolute loyalty to a leader who was actively treating the corporate treasury as his own personal bank account. How does a board of directors allow a founder to operate with zero adult supervision? The self-dealing was breathtaking in its audacity. Adam Neumann personally bought commercial buildings and then turned around and leased them back to his own company. He was effectively acting as both the CEO and the landlord, extracting wealth from his investors to enrich his personal portfolio. He took massive personal loans from the company at highly favorable interest rates to fund his lavish lifestyle. He flew across international borders on a private Gulfstream jet with marijuana hidden in a cereal box. Why did no one step in to stop the madness before it was too late? The corporate governance was functionally non-existent. Neumann held super voting shares that initially gave him 20 votes per share. This granted him near absolute dictatorial control over the entire enterprise, rendering the board of directors completely powerless to stop his worst impulses. The company succession plan bizarrely named her wife, Rebecca Neumann, as one of the people who would choose the next CEO if he were to suddenly die. You witness a public company operating like a feudal monarchy. Does absolute power always lead to absolute financial destruction?
The illusion finally shattered in August 2019. WeWork filed its S-1 prospectus to prepare for an initial public offering. The document was designed to hype the company for public markets and drum up retail excitement. Instead, it served as a complete and catastrophic exposure of the broken economics and the deeply rotten governance structure. The numbers were absolutely terrifying. How do you hide a billion-dollar loss from the public markets? In 2018, WeWork generated $1.82 billion in revenue. They suffered a staggering $1.9 billion net loss during that exact same period. They were spending more than $2 just to generate a single dollar of revenue. The first half of 2019 showed $1.54 billion in revenue against a net loss of $904 million. They carried roughly $47 billion in inescapable long-term lease obligations. Why did private investors ignore these apocalyptic financial metrics for so many years? To mask the bleeding, they invented fictional accounting metrics. They heavily utilized a highly controversial custom metric called community-adjusted EBITDA. This completely fabricated number stripped out standard expenses like marketing, administrative costs, and basic operational overhead to artificially make the company look closer to profitability. Public market investors immediately balked at the sheer absurdity of the math. You cannot simply erase your expenses and pretend you are running a profitable business. Does Wall Street ever actually fall for made-up accounting numbers? The collapse was incredibly swift and absolutely brutal. Within 6 weeks, the targeted IPO valuation was slashed from $47 billion to $20 billion to just $10 billion. The market flatly refused to buy into the delusion, forcing the company to officially withdraw its initial public offering in September 2019. The tech illusion evaporated overnight. You watched the most hyped startup in the world become a global laughingstock. How much wealth can one man destroy in just 42 days? In late September, Adam Neumann was finally forced out as CEO. SoftBank facilitated his exit with a staggering golden parachute package that was initially valued at around $1.7 billion. This included the right to sell up to $1 billion in stock, a $500 million credit line to repay his loans, and an incredible $185 million consulting fee. The optics severely damaged SoftBank and infuriated thousands of employees whose stock options were now completely worthless. You see a system that rewards failure at the highest levels. Why do the people who caused the crash always get to walk away rich? In October 2019, SoftBank orchestrated a $9.5 billion rescue package to save the company from complete insolvency. They took roughly 80% ownership, and the valuation was effectively marked down to roughly $8 billion. WeWork eventually went public via a SPAC merger in 2021 at a drastically reduced $9 billion valuation. Gutted by the global pandemic and the permanent shift to remote work, the company could not escape its fixed lease liabilities and officially filed for Chapter 11 bankruptcy in November 2023. You witness the death of an empire. What can we actually learn from this spectacular $47 billion failure? Here are the 3 critical lessons every investor and entrepreneur must understand from the autopsy of WeWork. Lesson 1 is the extreme danger of the tech illusion. Wrapping a traditional, capital-intensive real estate business in tech branding and ping-pong tables can artificially inflate valuations in private markets, but public markets will eventually force a brutal reckoning based on true unit economics. You cannot code your way out of a 15-year commercial lease. A physical desk is not a scalable software product. You must evaluate a business based on its actual structural costs rather than its marketing vocabulary. Lesson 2 is the governance trap of the visionary founder. Supervoting shares and the cult of the founder removed all necessary checks and balances from the corporate structure. When boards abdicate their fiduciary duty to rein in a charismatic leader, blatant self-dealing and reckless expansion become completely inevitable. You need independent voices who are willing to say no to the person in charge. A visionary without adult supervision is just a liability waiting to explode. You must demand strict corporate governance before you invest a single dollar. Lesson 3 is the destructive nature of toxic venture capital and the growth at all costs mandate. SoftBank and its endless supply of cheap capital did not just enable the bad behavior at WeWork, they actively demanded it. By pushing a deeply flawed business model to scale prematurely across the globe, the investors accelerated the company toward its ultimate destruction. You cannot scale a negative margin business into profitability just by adding more customers. Capital is a weapon that can destroy a company if it is deployed without strategic discipline. You must ensure the unit economics actually work before you pour gasoline on the fire. Just days before taking his $47 billion company public, Adam Neumann forced WeWork to pay him $5.9 million for the right to use the word we. This is the autopsy of WeWork, a $47 billion company built on an illusion and the $5.9 million trademark that should have been the first warning sign. If this breakdown was useful, the next autopsy is already in the queue. Subscribe for the next case study.